Hello, everyone. Joey again. Wanted to give a quick update. First off, get the disclaimer out of the way. This is not investment advice. We do this for education and entertainment purposes only. Um, what I wanted to show is I was reviewing my portfolio today and some of the positions that I'm holding. One of them that I want to focus on today is CLOV, CLOV. Um, I noticed that the stock price was going up a little bit, as a lot of stocks are going up today, and a lot of stocks tanked after the Fed gave their speech. So, in any case, all right, let's go over to Clove real quick. I want to go ahead and show this. Go ahead and filter down positions only. Clove happened to be the first one, so here we are. So currently we own 400 shares of this, and we have 200 shares that are in put contracts right now that expire this Friday, and the strike price is $1, and it's setting at $1.09 right now. Was the last price. So, that may expire out of the money, and we may pocket that. So anyway, my problem with this stock, and I mean this is a common problem with other stocks. It's just this is on a much more smaller scale, so that's why I wanted to show this one off in particular to kind of show you the thought process and the and the strategy with this. So you can see my overall cost basis without premium, just based on stock purchases, is setting at 201 for the 400 shares. And I mean, if this put was to execute, it'd pull my cost basis down to $1.67. But I had the idea. I was like, well, what if I just bought several hundred shares today at $1.09? I mean, that would pull the cost basis down significantly. And why would I want to pull it down? Well, I'd want to pull it down because if you notice, I'm selling 4 call contracts on the 400 shares that I have, but my cost basis without premium is up at 201. So if I'm interested in keeping the premiums, which everybody should be probably if we're investing for cash flow or buying these stocks for cash flow. So I have to set it up at $2 to be safe, and this is a common problem with people buying stocks, and the stock price goes down, and it goes down so far that you can't really. I mean, for the price that you bought it at, it's not worth anything. You can't get any premium for it, or you can get very little premium for it. So what I'm trying to show you today is a way to pull this down, and one way is to just buy the stock at a lower price, and then you can do it. But the way I thought about it is, well, if I'm going to spend money at $1.09, how can I do that today and get paid to do it? Well, I went out and looked at the Clove options that were trading today, and the puts were trading the $1.50. I'm looking specifically at the $1.50 puts, because I'm thinking if I'm going to buy the stock at $1.09 or $1.11 or whatever anyway, how can I get paid to do that? The stock option strike price at $1.50 was trading today for 42 cents. And I can actually just show you the screenshot I took of the thing. What I ended up doing is I purchased 3 contracts expiring this Friday at $1.50. And I mean, if the stock price in the next 2 days does not go above $1.50, so chances are really low that's going to happen, I will get called or assigned these shares. So I'll buy them effectively at $1.50 for 3 contracts. So that's 300 shares I'll be getting at $1.50 a piece. But really, I got them at $1.08 because I got paid 42 cents to do this today. So effectively, I'm still buying them at the price that I would have bought today, but I'm getting the premium in addition. And I mean, averaging it out, it's still $1.50. So really, I'm just pulling the cost basis down based off $1.50. I'm not pulling it down based off $1.09. So that won't pull the cost basis without premium down as much, but it will pull down my overall premium. And in fact, if the stock price goes up in the next couple days to just a few pennies, or if it goes up $1.25, I actually would have made some money on that, other than just capital. So anyway, let me go ahead and put this trade in to the web application so I can show you how this affects and changes the numbers. So what I want to do is go ahead and take another screenshot of this, because I want to show the before and after effect that this is going to have. All right, so we got that screenshot off to the side. So now let's go ahead and enter the transaction. So we want to go and do a new position, and this is a trade I actually executed today, so it took place. So we can go ahead and enter it, and we sold to open a put contract. We did 3 of them. It expires this Friday. The strike price was $1.50, and the price we did it at was 0.42. So we got paid the 42 cents up front. So they gave us 126 bucks basically. It was really 124. I'll show you that in a second. To buy it at $1.50 in a couple days. And I wanted to buy it today at this price, but I figured just instead of doing that, why don't we do this, and then I get paid to do it. And yes, I'm not really getting paid. I'm just getting paid in capital to do it. But, you know, if I keep on, the reason why I did it, I'm just going to keep on doing this, and I'll show you why I did it, because it's going to allow me to target a lower strike price, because these 4 calls are going to expire this Friday. So what doing this is going to allow me to do is go down a strike price and start selling call contracts at that lower price, which should in fact have more premium available in theory. All right, so we clicked save on that, which produced the proposed record. Remove the proposed record down, and thanks to Ameritrade, we're doing this over an Ameritrade system, which I am going to pop over there in a second to show you the trade and how it's represented in that tool. So it's 124.01. It was the actual premium received. Click save. All right, so we have the position represented. We have the transaction saved to the transaction history. So now here's our new updated summary. Okay, and this screenshot is the old one. So none of these numbers on the left changed. That should stay the same. The puts changed because now we have 300 shares more. The collateral increased by $450. The credits received went from 92, up to 216. So our overall gain went down, our overall loss went down. But now the things to really look at is the cost basis still stayed the same at 201 because these are just puts. They haven't actually taken effect yet. When they do take effect, it should lower my cost basis down to $1.61. It actually won't lower it down that low because 200 of these puts is actually from the dollar strike price, but it's going to pull it down. But really, really what I wanted to show you is the cost basis with premium went down from $1.77 to $1.46. So in truth, if I still wanted to break even and keep the credits, I would still have to target a $2 cost basis for the premium, but this gives me options. This now allows me to target the $1.50 strike price and come out a little ahead. I mean, it's basically breaking even and getting out of this stock. And why this is important is it's good to at least be able to break even on a stock, even if it's giving up the credits and premium you received. And the primary reason for that is just like if the stock dries up, it's not giving you any more premiums. It's really hard to give you premiums for the near term. You got to go out really far into the future in order to get premiums. So basically I was just showing this to you as a means to show you a way to gain options on higher price stocks. When the stock price drops more significantly, more than just 50 cents or $1, doing this kind of thing can really start pulling the cost basis down a lot more than normal. So in any case, after Friday, when we do the weekend review on this one, those 3 should definitely fire, and this cost basis right here should go down close to that $1.61 number, and then we can start really showing the power of doing this. And we can when we go to sell the contracts again, the call contracts, we won't be targeting this $2 one. We'll be able to target the $1.50 one, which the $1.50 most assuredly will have more premium than the $2 strike price. So before I end this video, I wanted to go ahead and pop over to the Thinkorswim tool. I have CLOV pulled up already. So as you can see right now, the $1.50 close to the end of the day was a bid ask spread between 35 cents and 50 cents. We got 42 cents earlier today for this position, and you can see the three represented here. And again, I like thinkorswim because it shows me where in the option chain my positions are represented, and then also it shows the three over here with the -3 right there. So also it colors, it highlights the line items that are actually in the money at this point in time. So that's another thing I like. But anyway, I just wanted to show you that real quick, and you can see that it is in the money because of this highlight setting $1.50, and the last was $1.09. So anyway, that's all I wanted to show for now. And so thank you for watching. If you haven't done this already, go ahead and go out to the website. You can get a free account and you can start playing with this tool yourself. If you haven't subscribed already, I would appreciate it if you did subscribe to the channel. If you liked the video, that'd be great too. And also hit the notification bell so you'll get notified whenever we push out another video. Thank you, talk to you soon, and I'll see you in the next one.